Hello everyone, this is Professor Zhang at MTSU. In this chapter, we will go through some basic aspects of futures markets and more importantly, we'll discuss future pricing by using non-arbitrage argument. Then we'll introduce some basic futures strategies in terms of assisting our portfolio management. Okay, let's get it started. Okay, what is futures? A futures contract is an agreement between buyers and sellers in terms of purchasing or selling certain assets on a given future date at a given price. That's the definition of futures contracts. Essentially speaking, futures contract is a commitment for both buyer and seller. And at the beginning of the settlement, at the beginning of establishment of futures contract, both buyer and the seller do not need to pay the full amount of underlying assets. They simply make a commitment, and by making a commitment, both sides actually post the margins on the account. And between buyer and seller, there are future exchanges. And what a future exchange does is they enforce so-called margin mechanism, make sure that all futures contracts can be settled in the future, and margins are marked to the market. Make sure that no counterparties can leave the futures contract without paying the money for their liabilities. United States, we have three major futures exchanges, and two of those are located in Chicago. One is CBOT, the other one is CME. CBOT, Chicago Board of Trade, and CME is Chicago Mercantile Exchange. And both exchanges actually trade financial futures contracts as well as commodity futures contracts. New York Mercantile Exchange is another exchange, future exchange in the United States, and this exchange is specialized in energy product related to futures contracts. In Europe, there's a large futures exchange, Eurex, that's dominating Europe Futures Exchange. Right. As I said, the most important thing that a futures exchange does is, first one, provide guarantees to both buyers and sellers to honor the contract through margin mechanism, and second, they standardize the quantities and quality of underlying assets. And many underlying assets can be traded through futures contracts, including both commodities and financial assets. And here are major types of underlying assets that can be traded in a futures contract. First one is agriculture products, and those are grains, cattle, orange juice, wheat, corn, so on and so forth, and those are agriculture product futures contract. And on CBOT, you will see a lot of agriculture products are traded within futures contract. Other than agriculture products, we also have metals, energies, as other types of commodities such as copper, gold, silver, and regarding energy products, we have oil, gas as underlying assets for futures contracts. In addition to those commodities are real stuff. They have physical form. It's a real thing, and we also have financial assets related to futures contracts. And in those futures contracts, we have financial assets as underlying assets. For example, stock indexes, individual stocks, and those equity products can be underlying asset of futures contract. And also we have bonds, especially treasury bonds, and the futures contract that makes treasury bonds as underlying assets, also called interest rate futures. And here interest rate is just a number, is not a feasible asset, but interest rate has a very close relationship with treasury bond prices, and we know that there's an inverse relationship between bond price and interest rate. So the future price changes in Treasury bonds reflect the changes in interest rate. That's why we call those Treasury bond futures contract as interest rate futures. In addition to stock indexes, stocks, bonds, we also have foreign currencies as underlying assets of futures contract. And here we have major currencies that can be traded in a futures contract, such as the euros, Japanese yen, Swiss francs, so on and so forth. And the foreign currency futures contracts are very, very useful tool for those multinational companies to manage the risk in foreign currency exchanges. So on the futures market, who are playing the game? I mean, there are thousands or even millions of investors engaged in the financial markets, but we can distinguish those players in three major categories. The first one is hedger, the second one is speculator, and the last one is arbitrator. So who is a hedger? I mean, hedger did not use futures contract to bet on the commodity prices. They did not. Instead, they use a futures contract as a risk management tool. And the great example is how farmers can utilize their short position in agricultural products to protect their farming business from any unfavorable movement of agricultural product prices. I mean, from farmers' perspective, they have, let's say, wheat available on their farm to sell in the future, but their concern is, what if wheat price declines, right? And by combining their long position in wheat and a short position in futures contract, they can effectively eliminate the risk of wheat price decline. In this case, farmers are doing hedge by using a futures contract. They're not using futures contract to bet on the wheat price, but instead they use the futures contract to hedge against the commodity risk. Second type of players on the market is so-called speculators. Speculators actually take tremendous amount of risk by betting the asset price in a futures contract. Due to the high leverage, speculation is very, very risky on the futures market. Let's assume that you believe that oil price will increase by 10% for next 3 months, and you want to maximize the gain by using a futures contract. Let's say futures contract give you 20 times leverage. So if oil price does increase by 10% for the next 3 months, then your total gain will be multiplied by 20 times, from 10% to 200%. So the leverage offered by futures contract is very attractive for those speculators if they are right about the asset price forecasting. But in case they were wrong, then their position can be easily eliminated by a small percentage of change on the market. For example, let's say the leverage is 20 times. In that case, if asset price declined by 5% and the speculator is betting on price increase, in that case, their principal will be wiped out very quickly. 100% be wiped out due to the 5% decline in asset price. So speculation is very, very risky. And on the market, both hedgers, speculators trade futures contract, and they share risk. And futures market is a great place for all kind of investors to trade risk, share risk. And the last type of player on the market is arbitrators. Arbitrators know a little math, and they can figure out if a certain futures contract is mispriced or not. If somehow they can find a future price is not equal to the theoretical price they calculate, then they can take arbitrage action, take long short positions into different securities, but with the same underlying assets. They can get a risk-free return. They can get a risk-free money. Right? So arbitrage means that smart investors in the futures market can discover the mispricing in a futures contract and take arbitrage action to earn risk-free money. Right? So in this case, their investment is 100% risk-free. 100% risk-free. And we will introduce some strategies in terms of how to use arbitrage strategies to explore the risk-free money on the futures market a bit later. And most investors will go to futures exchange to get access to futures contracts, and others may go to an investment bank to have a specialized futures contract, which is not tradable on the exchange, but it has a similar feature of the futures contract, just it's not tradable on the exchange, and we call those as forward contracts. We call those as forward contracts. So forward contracts is not tradable on the exchange. It's a private agreement between futures market participant and a certain investment bank. Right? And the difference between futures contract and a forward contract can be viewed on this table. There are four major differences. Futures can be traded on exchange, but a forward contract cannot. It's a private contract between the customer and their banks. And in terms of settlement, there's a daily market-to-market margin mechanism work in any futures contract. Right? And therefore, any investors in a futures contract face no credit risk because of this market-to-market margin mechanism. No credit risk for both buyers and sellers in a futures contract. But if a forward contract is settled on the maturity date, typically there's no market-to-market mechanism. Therefore, both counterparties in a forward contract may subject to certain amount of credit risk. And the futures contracts are standardized. However, forward contract can be customized based on a client's special needs. For both futures and forward contract, investor can take either a long position or short position. And here we take a long or short position because it's not like buyers actually buying anything in a futures contract. At the very beginning, they simply make a commitment in terms of if they want to buy or sell certain assets at a given price on a future date. But at the very beginning, there's no exchange of the goods and the money, and simply we call this as a long position or short position. So for long position holder, they promised to purchase certain amount of assets on a given future day at a given price. That price is given in a futures contract. And for short position, the short position holders actually promise to sell certain assets on a future day at a given price. That's a long position versus short position. Right? So if you use a futures contract for speculation purpose, and if you forecast that as the price will increase, then which position do you need to take? The answer is very simple. You need to take long position, right, to maximize your gain. Based on forecast that as the price will increase. But if you bet on price to decline, then you should use a short position. Right, so that is for speculation. And the margin requirement is a very smart mechanism imposed by the exchanges, so that both buyers and sellers will have no chance to default on their obligation that they made in a futures contract. Right? And the margin should be posted for both buyers and sellers, and essentially margins are faithful deposit for the commitment that they made in a futures contract. So let me ask you a question. Do you think the futures market will get better in year 2018? Well, you might say, hey, futures market will get maybe a little better, or maybe a little worse. But the question here is a little problem, because futures market is very different from stock market. And you can ask a question like this: do you think stock market will perform better next year or not? But for the futures market, you just cannot say so, because When you look at the overall value of the futures market, what can you say? I mean, in the United States, we have 25 trillion US dollar total value stock markets, right? But what about the futures markets? I mean, there are several futures markets in the United States. What is total value? Total value under the futures markets? And the answer is very simple. All right. You might take a guess. You say, hey, 10 trillion US dollars, maybe more or less, but the right answer is 0. The total value of the futures markets is always 0. All right. Anytime, any place, the total value futures market is equal to 0. Why is that? Because futures market represents a zero-sum game. At the very beginning, both counterparty involved in futures contract, and the value of the futures contract to both counterparty equals 0. As time moves on, you see as the price will change, right, which will bring either gain or losses to either long position holders or short position holders. The thing here is, this is a very typical zero-sum game. Any gains the one counterparty is getting must be the losses for other counterparty. So in any futures contracts, although buyer may have gains at a certain time, but that gain must be the losses for their counterparties. So when you sum up the values of buyers and sellers in a futures contract, is always equal to 0. It's a typical zero-sum game. In terms of settlement, cash settlement is much more popular than physical delivery, right? And cash settlement accounts for more than 99% of futures contract settlement, because cash settlement is more efficient than physical delivery. As we discussed on the futures market, we have 3 types of participants. They are hedgers, speculators, and arbitrageurs. In terms of how to use the futures contract, of course, there are 3 different ways that people can utilize futures contract. They can use it for risk management, like what the hedgers do, and they can also use futures contract to do the speculation, or they can use opportunity they discover in the futures market to do arbitrage. Alright, this picture shows you a very interesting phone call between a car and this car looks like a futures market broker, and he's talking to his client, and he said that, trust me, cattle futures are the last place you want to invest. Now, let's take a look at the payoffs of a typical futures contract. And here on the left, you see the payoff futures contract for the long position holder. On the x-axis, that is the price of the asset, and F0 here is the future price specified in a futures contract. And this blue straight line, 45-degree upward sloping blue straight line, showed you the payoffs of futures contract, or the values of futures contract for a buyer or long position holder. So this blue line shows you that when price of an asset increase beyond the future price F0, then you will see positive profits for long position holder. But if price declines below F0, then there will be losses. There will be the losses, right? And the maximum loss for long position holder is equivalent to the future price of that assets. But for the potential gain, there's no limitation on how much that long position holder can make in a futures contract. And on the right, you see the payoff for short position holders. For short position holder, it's the opposite, right? And they make money when price declines below F0, and they lose money when price increases. The opposite position as you see for the long position holder, right? And by the way, for short position holder, you see that short position holders are facing unlimited amount of losses when price increase dramatically in the future. There's no limitation how much money they can lose. But on the positive side, their maximum gain is the price of the underlying assets in the futures contract. So that's the very very natural weakness for short position holder. They always face unlimited amount of losses for the futures contract. So relatively speaking, short position holder is taking more risk than long position holder due to the unlimited amount of losses. Now, let's take a look at how we can price a futures contract. How we can price a futures contract as a very typical derivative. It's really challenging for us to follow the traditional way to get a future pricing formula, because future price is based on something that will happen in the future, right? And here the smarter way is to use non-arbitrage argument or arbitrage pricing principle, which follows the law of one price. And here I will demonstrate how we can use this non-arbitrage approach to price a futures contract. And the best principle that we follow for the futures contract is called the spot futures parity theorem. Spot futures parity theorem. Let's look at how this works out. So essentially speaking, this F0 is the future price in the futures contract for a certain underlying asset. Right? This is a future price. Let's say for 3 months futures contract, for 12 months futures contract. Excuse me. This futures price is a function of current underlying asset price. S0 is current asset prices, right? And it's a function of current asset price, but it incorporates 2 other variables. One is actually 3. The first one is carrying cost. The other one is convenience yield. Convenience yield. Right, so equations show you that futures price equals current price times 1 plus carrying cost rate minus convenience yield rate raised power of t. So what is carrying cost? For a typical commodity trader, if they buy certain underlying asset, let's say buying 100 tons of natural gas, sweet oil, then they needed to find a place to store it, right? They might need to find a warehouse, store it. They might need to hire people to look after the inventory, so it involves storage cost. In addition to the storage cost, carrying certain amount of assets also involves the opportunity cost, because you spend money to buy those inventories or commodities, and those money are not free, and we need to consider opportunity cost, right, as interest cost, because any investor need to pay interest on the money that they utilize. So carrying costs have 2 components: interest cost and a storage cost. What is the convenience yield? Well, the convenience yield is something that you can get from holding a certain amount of assets. And the example here is, if you hold a bunch of stocks, then you may get some benefits by holding stock, because stocks may pay dividends. So those dividends that you receive from holding stock would be one kind of convenience yield, and a convenience yield can offset part of your carrying cost to lower your total cost of holding certain amount of assets. And another example convenience yield is live cattle. Let's say you have 1,000 live cattle, and some of those are male, others are females. And if you, let's say you hold this large group of cattle for 1 year, and the next year you find that you have more cattle. How do you get those more cattle? Well, over a 1 year time period, you may get some baby cattle, and those baby cattle are valuable. They can be sold for actual money. So baby cattle is another example of convenience yield. So holding certain amount of assets not only involves a cost, like a storage cost, interest cost. It may also bring you benefits such as convenience yield, which can lower your total carrying costs, right? And this equation is a very powerful equation. As I said, this equation is based on non-arbitrage argument, which means it must hold, otherwise there will be arbitrage opportunities. All right? So how come? Let's look at one example. Now, one example to see how this spot future parity theorem works. And actually, the equation that you see here is based on spot future parity theorem. Right? Let's say you observe. Future price in a futures contract based on a certain underlying asset, right? And actually, you can figure out what a reasonable future price should be based on your holding of that asset, right? And let's say in 3 months, gold price is going to be $1,500, and right now, gold price is $1,400. And actually, you can replicate that futures price by holding the real asset from day 0, and you hold it until the turn to maturity. And when you consider all the carrying costs, convenience yield, it must equal to the future price. Otherwise, there will be arbitrage. Let's say you found that let's say the total cost of you to carry a certain asset is R, which is the interest, right? And let's say this is financial assets. You do not need to spend any money on the storage. Only cost is interest, right? And assuming there's no convenience yield, so the total cost is this RF, right? And actually, you found that future price is higher than the price that you can replicate by holding that assets in the future. In this case, it may generate arbitrage opportunity. So here, let's say future price is $1,500, but after all the calculations, you figure that if you can hold that asset for the next year also, and the total cost is $1,450, in that case, you will have $50 profits, right? And I mean, it looks like futures market actually mispriced this underlying asset, so you wanted to explore the arbitrage opportunity. So here, what do you need to do? Well, if you think that the price in the futures contract is overvalued, then we should sell it, right? And let's say the asset that you're holding, or spot asset that you're holding, is a reasonable price, then you buy it. So arbitrage involves buy and sell the same underlying assets in two different securities. It could be a financial contract, it could be real assets. So here you buy low, sell high simultaneously, right? So the price for you to hold that asset is S0, then you buy it, right? And the future price is higher than what you believe, then you should sell. You buy low, sell high, right? And when you buy low, you spend S0. When you take short position in the futures contract, it doesn't involve any cost, right? But you needed to borrow money to buy that asset, because as arbitrage, you're not supposed to spend your money. You're supposed to spend 0. Right? You spend 0 and you make some money in the future. That is arbitrage. So on this table, you see that the money that you need to buy the spot assets is financed by borrowing. So initial cash flow equal to 0. Now let's look at the cash flow at the time t. So if you borrow S0 today, in the future you need to pay interest, right? that is equal to negative S0 times 1 plus R raised to power T. That is principal plus interest payment. It's negative, which means you need to pay money. And since you buy spot for S0 at time 0, and in the future, that asset price will increase to ST. It's a different price. It could be higher, could be lower. It doesn't matter here. When you take a short position of futures contract, and in this case, the payoff on that futures contract should be equivalent to future price minus future spot price of that asset. Right? And when you combine anything, and when you combine everything, for this strategy, at the time t, you will find that it equals F0 minus S0 times 1 plus R raised to T. Right? And so, in theory, if there's no arbitrage, since you invest in nothing, take no risk, you should earn nothing, right? You should earn nothing. Right? Otherwise, there will be arbitrage. Right? So, this F0 minus S0 times 1 plus R raised to power T must equal 0. Otherwise, there will be arbitrage. Then we manipulate this equation a little bit. We found that this F0 is a function of S0. Right? F0 equals S0 times 1 plus R raised to power T. So which means future price equals current price times 1 plus R raised to power T, assuming that the interest cost is the only cost by holding that assets. So future price essentially is equivalent to spot price plus the cost of carriage. I mean here it should not be negative, it should be positive. Right? So future price of a real asset should equal to the current price plus total cost of carry. As I said, this equation is very powerful because if it doesn't hold, then it generates arbitrage opportunity. Let's take a look at some example how we can apply this equation to calculate future price. Alright, this is the first example. Let's say gold is currently priced at $1,350 per ounce and a risk-free rate 3%. Let's ignore storage costs and convenience yield. The question is, what is the gold 3 months futures price? And here's a very simple, right? And the only carrying cost the interest rate 3%. So here current price $1,350 times 1 plus the interest rate raised power of 1/4. Why 1/4? Because 3 months is 1/4 of 1 year. So here future price for gold in this 3-month futures contract should equal to $1,360. Now let's change our assumption a little bit. Let's say the gold current price $1,350 on the spot market, risk-free rate 3%, storage cost rate 0.5% a year, and a convenience yield 1% a year. And what is the gold 3 months futures price? And here you consider both carrying cost and the convenience yield. And there are two carrying costs. The first one is interest rate of 3%, and also the storage cost of 0.5%. And since convenience yield is 1%, that's the benefit that you can get by holding gold. Therefore, it can offset your carrying costs. So this F0, future price. 0 means right now, future price of gold right now for this 3 months futures contract equals $1,350 times 1 plus interest rate plus storage cost rate minus convenience yield and raised power of 1/4. It equals $1,358.36. Right. And this price has to hold. This price has to hold. Otherwise, there will be opportunity of arbitrage. Now let's look at an example to see how we can do arbitrage. Right? If you see gold future price is misvalued in the futures contract. Let's say if the 3-month gold future price is $1,389, then what can you do? What can you do to explore the arbitrage opportunity? I mean, based on your calculation, considering all the costs, storage cost, convenience yield, interest rate, the future price for gold should equal to $1358.36. But right now, it's $13.89 on the futures market. And it's very clear that the current future price is overvalued. So what can you do? What can you do? And the basic principle for arbitrage is you buy low, sell high simultaneously. Buy low, sell high simultaneously. You take two positions, one long position, the other one is short position, and you take two positions simultaneously, right? In two different places, but with the same underlying assets. And here the underlying asset is gold. Where can you find two places? Well, the first one is the futures market, and the second place is the spot market, where you can buy gold right now. So here you buy low, sell high. Right? Where is the low? Where is the low? 1358.36. That is the low. Right? Where is the high? 1389. So buy low, sell high. How to sell high? Sell high is easy in this case. You simply take short position in the futures contracts. Take short position in the 3 months gold futures contract. Right? And so in the future, what do you need to fulfill is to sell gold, right? Sell gold at a price of $13.89 in 3 months. That's the obligation that you specify in the futures contract because you are taking a short position. Now, let's say we wanted to buy the 1358.36. How can we buy? Well, here you needed to buy the real asset of gold today and hold it for the next 3 months. Alright, and since this is arbitrage, you're not supposed to spend your own money. And right now, the gold spot price is $13.50. You can buy gold as a real asset at $13.50, but you don't need to spend your own money. You borrow money from a bank. You borrow $13.50 from the bank with 3% interest rate and buy gold at the current price, $13.50. Right. So in this case, once you finish this, you have a liability with the bank. You're supposed to pay back that $13.50 plus interest. Right. On the other hand, you have this physical asset of gold. Physical asset of gold. You are going to hold the gold. Why do you need to hold the gold? Because you're involved in a short position in the futures contract, and that contract actually requires you to sell gold in 3 months. And right now, you are building the inventory of gold in order to sell gold in the futures contract. You see that? And today you borrow money, buy gold, and I mean you have the physical asset of gold, but you also own bank money. But overall, your cash flow for today is zero. Your overall cash flow for today is zero. It's like you take your position in 3 months gold futures contract. It involves zero cost. I mean, initially it involves zero investment for you, right? And this is a combination. This combination, okay. This combination has, okay, first of all, short position in futures contract. Second, you own bank $13.50 with 3% interest, right? And also you have physical asset of gold. I mean, this is like a portfolio. And when you get into this portfolio, your total expenditure is zero in terms of cash flow, right? And in the future, there will be obligations occur in this portfolio in terms of futures contract, in terms of bank borrowing, as well as the price of your real asset of gold. But at the very beginning, you spend zero. If you spend zero, you're supposed to earn zero in the future, right? But here's a very interesting thing. At the end of 3 months, you needed to sell gold at agreed price of $13.89 based on the futures contract. Right? Can you make that happen? Well, no problem, because you have the gold. You hold the gold for 3 months, right? And of course, you can sell gold. but you will receive $13.89. Right? And this is not your money yet because you need to pay back the bank loan. $13.50 plus interest. So loan payment plus interest $13.60. Right? And in addition to this, you need to pay storage cost, $1.69. Meanwhile, you have some convenience yield by holding the real asset of gold. That's $3.36. And when all the cash flow cancel out with each other, you will get a net cash flow of $30.60. That's what's left in 3 months for your portfolio. This portfolio has short position, the futures contract. You have relationship with the bank, you need to pay back the principal and the interest, and also you have real asset of gold, right? But the price actually changed. But overall, your net cash flow is $30.64. So what should we do about the $30.64? Well, I can say, this is your money. Go ahead, spend it. That's your money. That's your risk-free profit. That's your risk-free profit because you invest zero, right? And there's zero risk. All the liabilities actually met, right, at the end. But somehow you get this $30.64, and that is your arbitrage portfolio. It doesn't seem a lot of money, but actually you can amplify the $30.64 into 30 million or even 30 billion, depending on the size of your transaction. So the example shows you how to do arbitrage, right? If you found that future price is misvalued by the market. What if future price equal to $1,300, which is less than what you calculated through that equation? Then what can you do for your arbitrage? I want you to take this scenario as exercise to see what you need to do. What you need to do the arbitrage. Remember, the key here is buy low, sell high simultaneously. Now let's take a look at a more complicated example. This is for stock futures contract, and for stock, there's a unique feature for dividend payment. And most stocks will pay dividend, and we view dividend as one type of convenience yield. In terms of storage, because stocks are electronically registered, it involves basically zero storage cost. Right? And interest rate is always there, and on the financial market, we can use risk-free rate as the interest rate in calculating cost on interest. So for stock future, for individual stock futures, we need to consider both the dividend and interest rate. There's no need to put storage cost into our equation. But the complexity here is caused by this dividend. Right? And previously, in the equation we see convenience yield rate. If it's expressed in percentage, it's much easier to handle. But here, it's more likely that we only know the amount of dividend, not the ratio of dividend. But anyway, we have one alternative solution for stock futures price for our stock forward price. Right? And essentially speaking, we needed to first of all look at the present value of dividend, and dividend is convenience yield. Right? And convenience yield, the convenience yields can reduce your total cost of stock holding. So first thing is to look at the present value of dividend, and then we take the difference between stock price and the present value of dividend. Then we turn that with 1 plus R raised power T. R is the interest rate, T is time in this futures contract. Right. And let's do the calculation for this example. Stock price $30, dividend will be paid. Half dollar dividend will be paid in 3 months. Risk-free rate 3%. Let's see what is 12 months forward price for this stock. So first of all, You found stock price $30, and the second, you found dividend $0.50, but you need to discount it, right? A discount rate 3%. What is T? Well, T here is 1/4, because dividend will be paid in 3 months. So you discount this dividend 3 months from today. So it's 0.5 divided by 1 plus 3% raised power of 1/4. Then you time the entire term with 1 plus 3% raised power of 1, because it's 1 year forward contract. So that will give you $30.39 for the forward price for the stock futures contract. And on the financial markets, we have many special types of futures contract that a lot of investors can utilize, not only in speculating, but more importantly in risk management. And on the futures market, the most popular futures contract is interest rate futures contract. Right? Interest rate futures contract looks like the futures contract makes interest rate as an underlying asset, but actually it's not. The underlying asset for interest rate futures contract is bonds, typically treasury securities. Right? And due to the strong relation between the interest rate and the bond price, we call those treasury bond futures contract as interest rate futures. Right. And so how can we play this interest rate futures contract? Well, if a corporation is planning to issue a new bond, which means they are going to sell bonds in the future, but they have concerns on the interest rate level on the market, right? And they may worry that market interest rate may increase by the time they need to issue new bonds, right? And so what they wanted to do is to manage the interest rate risk in this interest rate futures contract. Since they are going to sell the real asset bond in the future, and to hedge against the risk of interest rate, which means their concern is higher interest rate, right? Higher interest rate means lower amount of bond issuing proceeds they can receive, or lower bond price. They feel that bond price may decline, right? And they are supposed to sell bond. They are the producer of the bond. So what kind of position do they need to take in this interest rate futures contract? Well, the underlying assets should be corporate bonds, right? Corporate bonds, similar corporate bonds, and long or short. In this case, the corporation will produce bonds. Right? They are going to sell bonds like farmers do. And what position do farmers need to hedge against the wheat price risk? They take short position. And here, it is the same. Right? And a company who want to issue new bonds in the future needed to take short position. To hedge against the interest rate risk. And the reason why interest rate futures are so popular, because we have tremendous demand from U.S. corporations along with other international corporations. And as we know, the goal of firm is to maximize shareholders' wealth. Right? There are two basic ways. The basic ways that a company can maximize shareholders' wealth. One is through increasing profits, increasing cash flows. That's one way they can improve the value for shareholders. The other way is to reduce the discount rate or cost of capital. Right? And most of the companies have debt financing. Therefore, in order to reduce cost of capital, they needed to find a way to reduce the overall interest expenses. Right? And interest rate futures can help those corporations to manage interest rate risk, to minimize interest rate cost. Therefore, they can reduce the cost of capital to improve shareholders' welfare. That is why interest rate futures is so popular on the market. It's number one futures contract. In recent years, both stock index and individual stocks index futures contracts become available to a lot different investors. And here is an example of several different futures contracts that makes different stock market indexes as the underlying assets. And a typical stock futures contract is pretty big. The total value of a typical stock index future is a little is something between $500,000 and $250,000 US dollars. Right? For example, let's look at a futures contract for S&P 500. S&P 500, and actually this futures contract makes S&P 500 index as the underlying assets. Let's say the current level for S&P 500 is 2,000. It's 2,000, right? And here the multiplier in the futures contract is 250. So the total size of the contract 250 times 2,000. That's equal to $500,000 US dollars, right? And the Chicago Mercantile Exchange trade a lot financial futures contracts, and the S&P 500 index futures contract is one of the most popular stock index futures contract on the market. And financial futures contract tend to have bigger size than commodity futures contract, and the typical size range from $250,000 US dollar to $500,000 US dollars. And the financial futures contract is a very useful tool for many money managers, and money managers can utilize futures contract to do so-called synthetic stock position. Right? So let's say you want to invest in a diversified stock portfolio, and you can purchase individual securities. Let's say 20, 50, right, to build a well-diversified portfolio. And for a passively managed fund, manager wish to mimic, let's say, S&P 500 market index, right? And there's a very simple way to do that. You simply buy 500 stocks listed in S&P 500, right? And so that you can replicate S&P 500 index. But doing that involves large transaction costs. You need to buy 500 stocks. That means 5 different transactions, right? And over time, the list of company will change. And also you need to rebalance your portfolio based on S&P 500 index changes. There's a lot of transaction costs involved in, right? And it's not a very flexible way to track the market index. And here, the synthetic stock position gives you a very flexible way to track market performance. Instead of buying individual stocks to form stock portfolio, you simply purchase stock index futures. Right, let's say the leverage is 20 times. In that case, you only spend 5% of your money, 5% of money as margin for this S&P 500 index futures contract, right? And that's equivalent to holding 100% of stocks in this portfolio. But the difference here is you only put 5% in the margins account, right? Once you initiate this stock index futures contract, and you have 95% of cash left in your account, and you don't need to do anything but cash, because the combination of this futures contract and cash position is equivalent to stock portfolio. So in the future, we'll definitely earn stock market index return. Plus, I mean, you have 90% of cash in your account. You can invest in money market instruments, right, to earn a little bit more return. So your synthetic stock position typically will earn a little bit higher return than holding stock portfolio. And more importantly, since you have large amount of cash available in your account, you have the flexibility to capture the future investment opportunities. Let's say in the future, stock market tanked, A lot of people wanted to buy low, but they cannot do so because they do not have cash. Their portfolio is fully invested. They don't have cash to buy low. But look, your portfolio has 95% of cash, and you can capture those valuable opportunities anytime you want. Right. And considering the transaction costs, it's also better than having a stock portfolio. Right. Having stock portfolio involves a lot of transaction activities and transaction costs, but when you do this synthetic stock position, you only make one trade. It minimizes transaction costs. So the synthetic stock position strategy is a very useful strategy for a manager who want to minimize transaction costs. Right? Have some flexibilities to capture future investment opportunities, and they can earn a little bit higher return by utilizing that 95% of cash in their portfolio. So this is a synthetic stock position. And for stock index futures contract, another interesting trading strategy is index arbitrage. And the market is not a perfect place, and sometimes you find that the price in the futures contract may be different from the price of underlying assets on the market. In that case, if you discover any discrepancy, that is exciting opportunity for you to take arbitrage profit. If future price too high, you take short position in the futures contract and buy underlying stocks in the market indexes. Right? And the difference would be arbitrage profit. If future price is too low, then you take a long position in the futures contract and take short position in those underlying stocks. That is index arbitrage that a lot of hedge fund managers can do. Foreign currency exchange, foreign currency futures market is a great place for multinational companies, international companies to manage the risk for their foreign currency exposure. As we know, most U.S. large corporations are no longer domestic companies. They are multinational companies. They have significant existence in foreign markets. Europe, Japan, China, India, and other developing countries. And in those regions, they use different currencies. Right? Companies have revenues, companies have costs, occur in those foreign markets, and eventually all the cost revenue need to combine together and be translated back into US dollars for the corporation reporting purposes. And in this case, the fluctuation on the foreign exchange market certainly impose currency risk for those multinational companies. And in order to manage the risk for foreign currency exchange, a company can utilize foreign currency futures contract or forward contract. Right? And it's another very popular futures contract among those large U.S. corporations. Right. Now let's take a break, and we'll go through some sharp strategies that you can utilize for portfolio management by involving the futures contract.